Thank you very much, Mr. Arun, for being with us today. It's a pleasure having you. Everybody, all the traders in all assets are waiting to hear from Jerome Powell, not only the step that he will take, but what after March meeting. How do you depend on today's meeting and Powell statements in the oil price movements losing 20% from the highest levels in 2 weeks?
So regarding FOMC meeting today, most analysts today are expecting a 25 basis point rate hike, primarily because this was what was priced in the markets like for multiple weeks, and any Fed move where they don't do a rate hike, that will be considered by the market as bearish even, primarily because markets will be thinking that the economy has weakened a lot. So that's the reason why the Fed is not proceeding with a 25 basis point rate hike. So that will be viewed negatively by the market. So we expect a 25 basis point rate hike today, and the impact will be kind of neutral on the oil markets, primarily because we expect this to be the last one in a series of rate hikes. Most likely, the Fed will be pausing here and trying to analyze the situation, whether it's regard to the banking scenario, whether it's with regard to the economic data or the job market. Fed will be trying to take a pause here and see what is exactly happening in the market. From an oil market perspective, this will be a bit of a relief because uh, one of the major threats to the demand scenario, especially in Northern America and Western Europe, is a coordinated central bank interest rate hikes that's happening. So any indication of a pause in the U.S. Federal Reserve should be some kind of a relief.
Prices retreated from its peak in March by 20% to the bottom that we have reached. Of course, it was in the beginning with the banking crisis, but the main reason for this retreat was the expectation of an economic recession. Today, if the Fed increased interest rates by 25 basis points, and let's think that it paused. Do you think it means or it will put the recession away?
So regarding the decline in oil price during the past 2 weeks, especially in the aftermath of the Silicon Valley Bank crisis as well as the Credit Suisse crisis in Europe, we need to view this in conjunction with other major asset classes. So we had seen the US Treasury bills, the yield falling sharply from 5% to 4% in a span of one trading day. There was a 100 basis point move. So what happened in the treasury bills market was a massive short covering. So everyone in the market, in the interstate market, was positioned for further rate hikes from the Fed. So when the Silicon Valley Bank crisis happened, the people were short on the market. They panicked, and that led to a rally in the treasury bills. A similar dynamic happened in the crude oil market as well. So lot of players in the market were positioned for a rally or a gain in the crude oil prices. So when in the aftermath of the crisis, there was a liquidation of long positions from the long commodity funds, as well as lot of market participations who are hedging the inflation bets through long oil bets. They also closed down their oil positions. Now, apart from that, there was a dynamic of a large number of shale companies, primarily US-based shale companies. They hedged their oil positions in the market by buying put options. So the banks who sold these put options, they had sold oil contracts to hedge their put option positions, which led to some kind of a negative gamma shock and a decline in the oil prices. So there were a combination of technical factors that led to a slide in oil prices. So we believe the worst, from a technical perspective, the worst is over, and the market fund trading perspective, it looks much more healthy. especially with both Brent and WTI from a trade on the charts bouncing back from the 200-week moving averages.
Thank you very much, Mr. Arun, for being with us today. It was a pleasure having you.
Thank you very much.